Hi, everyone, and welcome to today's special financial services focused webinar, The Digital-Only Banking Revolution. Thanks for joining us today here and on LinkedIn Live and Twitter as well. I'm Rob Rubin, General Manager of Financial Services at Insider Intelligence, and I'm going to be your host and moderator for this afternoon's presentation. Today, I'm remote in Montclair, New Jersey, and I'm joined by my New York City-based colleague, VP and Head of Financial Services Content at Insider Intelligence, Dan Van Dyke. Hey, Dan.
Hey, Rob. Thanks for having me.
For sure. Before we kick things off, a few housekeeping notes. If your colleagues haven't registered yet, it's not a problem. Just share the same link that you used to register and they can pop right in and join us. And of course, before we dive in, please keep in mind that you don't need to take notes. You're going to receive a link to view the slides and a full recording of today's presentation and panel. We also want you to participate. Just use the window on the lower right side of your screen to submit questions at any time. A few of you, a lot of you really, have already asked questions, which I've noted, and we're going to try to cover as we proceed. But we're going to leave time at the end for other questions too, so please keep them going and don't be shy. So let's get this started. If there's one thing we've learned over the last year and a half, it's that things can develop and change quite quickly. So we've built our team and resources to focus on what's happening today and how is it going to impact tomorrow. We like to frame our research in three ways. What fast developing trends do you need to pay attention to? What big trends and changes should you be learning about to shape plans and strategies? And how do you contextualize both fast developing and big trends within the FinServ ecosystem and your competitive set? There are a number of aggregators in the market and sources of information are infinite. Just think Google. But our research methodology is rigorous, consistent, data-driven, and unbiased. And really, it's one of the primary things that set us apart. We leverage over 3,000 sources to support our research and analysis and forecasting. And that includes Kantar, IDC, Forrester, CB Insights, Media Radar. And we use this data when we're researching a particular trend or topic. We curate the research, we analyze the data, we evaluate what's most relevant, accurate, and salient for our subscribers, and we employ our own research methodologies, including doing exclusive interviews with digital leaders, as well as doing large-scale structured surveys. We use all of this data to build our forecasts, our charts, and our reports. We're transparent, and we're willing to show you our work. Clients can see the raw data and research that go behind the numbers to make us a trusted and credible source to use. We're unbiased, and we don't offer a pay-to-play model unlike some others in the market. There's no agenda in our research based on any kind of monetary gain or influence. We deliver all this content in the form of trends reports, market forecasts, charts, which are ready to use for your work product, benchmarks, which help understand where you stand against your competitors, and something I like to call a morning smart pill in the form of a daily briefing that lets you know what's the most important news and trends in banking, payments, and fintech that you need to be aware of that day. Today, I'm really pleased to introduce Dan Van Dyke, who leads our financial services research team and co-authored the report we're drawing on today, as well as being the architect of our flagship benchmarks on mobile banking and digital trust. Dan and I have structured the next 30 minutes or so into three parts that answer what are the strengths, weaknesses, and long-term risks for the most developed US neobanks, Chime, Varo, et cetera. What are the major disruptors that could rattle the market for consumer banking, and how can incumbents counter the neobank threat? So Dan, why don't you kick us off and get us going here?
Sure. So we have a lot of content, and as you were alluding to before, a lot of different questions to get through, and we're going to try to hit them all. I thought I'd set the stage just by talking about the fact that digital-only banks are not necessarily new. So digital banks like Security First Network Bank, in fact, have been pioneering the model as far back as 1995. But what is new is that this latest crop of challengers, which throughout the presentation, we're going to refer to as neobanks, are breaking through into the mainstream. And throughout this presentation, just a quick definitional note, I'm going to use the term digital-only banks to be the umbrella term, so inclusive of incumbent digital providers like Ally and USAA. And when I say neobanks, I'm talking specifically about the more recent crop of challengers, and we'll highlight some of those specifically. So just a few points to bring really the full scale of the neobank threat into focus. Today, there are over 245 neobanks globally. And as of late 2020, neobank funding made up just over 10% of total fintech financing. And while there's more neobanks, more funding, and more users than ever, what is rare is profitability. And we're going to dig into that in a little bit. But first, I'd like to zoom in to see how adoption looks in two markets that we cover pretty heavily in our research, the US and the UK. And the UK you can really think of as a bellwether of things to come in the US. And over there, over 1 in 4 consumers currently has a digital-only bank, which again includes incumbents, but is primarily made up of neobanks. And in the UK, over 1 in 10 consumers has an account with Monzo. And in contrast, just over 11% of the population in the US has any sort of neobank or digital-only bank. And you might think, looking at those statistics, that that means the UK represents a larger market opportunity, but in reality, it's just more mature. So if you factor for the population size difference, there are actually double the number of adopters of digital-only bank accounts in the US as compared to the UK. So the big takeaway from that is that there are two ripe markets, one at a different stage of maturity, and there's going to be increasing cross-pollination. We've already seen that begun to play out. So for instance, we've seen Monzo hit some stumbling blocks as it tries to target the US market. We're also seeing Chase going the other way, so launching a UK neobank. And we're going to be featuring some of those UK neobanks in an upcoming benchmark later. By the way, just to throw Canada in the mix, because they are another big focus of our research, not so much for this presentation, adoption of digital-only banks is about 15% in Canada. So let's look ahead and let's narrow the lens to the US to see how this is going to play out looking ahead. And by 2025, you can see that 20% of the population, so 1 in 5 consumers, will have a digital-only bank account, and 15% will have a neobank. So to put some numbers to that, that's 54 million consumers and 40 million consumers respectively. And putting it into perspective, Bank of America has around 31 million mobile customers currently. So that begs the question, what is it that is powering this pretty incredible growth curve? And the first and most important lens to take into this is to break it down by age. And you can see two groups clearly stand out in terms of their adoption. So just to walk through this slide, the red bars represent 2021 adoption, and the gray bars add on to that the projected 2025 adoption. And you can see that 25 to 44-year-olds group, which Rob, I believe you call them the busy people.
Busy ones.
The busy ones. They are the current and future base of adopters for neobanks. So currently standing around 20% adoption. It's going to roughly double over the next 5 years to around 40% adoption. And that is not a trend that's slowing down. Interestingly, if you look at the 18 to 24-year-olds group, adoption is much lower than you might expect. We hear a lot about Gen Z. A lot of them are happy with the bank accounts their parents have. But once they've hit financial maturity, which happens around age 25, you can see a dramatic shift in their provider preferences happening.
You know, Dan, it's a good spot for me to ask a question from Donna. How are the digital banks planning to influence older consumers who are more comfortable with cash and brick and mortar branches?
Well, there is still a place for the branch. And you can see our own projections do not call for aggressive growth within the 55 to 64-year-old group or the 65 plus group. In fact, 65 plus, it'll only tick up from 3% to 4% adoption in time. So if you are happy with a full service banking relationship, we don't expect the neobank value proposition, which we're going to go into specifically in some of the following slides, is really going to turn over hearts and wallets from that group specifically. So what is that value proposition that is engaging the 25 to 44-year-olds? You can see three different examples of sort of flavors on the same value prop here, which is very much focused on financial health. So Varo says that if you want access to your paycheck early, Varo can have your back if you need to buy groceries and that paycheck maybe hasn't hit your account. With Current, you can do so up to $50 or $100 fee-free. And Chime has the tagline, bank accounts should not cost you money, which contrasts that to sort of a product line view of profitability, which is pervasive among a lot of incumbents. It represents a totally different way of looking at the customer lifetime value equation, and one that should definitely capture the attention of incumbents. So over time, we view this trend as neobanks grow more and more customers and maintain those low to no fee models will have an effective margin pressure on incumbent providers. And you can see a couple of stats that bring into focus the really night and day differences in business economics among neobank providers versus their incumbent counterparts. So account fees sitting at average annualized $0 for neobanks. This is an Oliver Wyman estimate from this year. $85 for incumbents. Compare that to operating costs. It costs neobanks about $50 on average to service one customer for a year, triple that amount for incumbents. So that means that they can continue to finance these flashy features. Add to that, the wave of venture capital funding, which is showing no signs of abating. All that means there are a lot of competitive pressures that we expect incumbents to feel in their business model as these new providers catch on.
This is a great spot to ask Patrick's question. He's wondering if there are historical analogies that we can draw from as a blueprint of what we could expect.
Yeah. So we happened to get this question in advance, and Rob, you and I were going back and forth on this one, but I sort of liken it to deep discount brokerages, what happened with sort of fee-free trading models catching on and putting a lot of margin pressure on providers, but on a slower timetable. We expect that as that margin compression happens, the sort of thinking around these services as getting consumers' feet in the door, and then you upsell them to a profitable suite of services will need to catch on among providers over time. And that siloed view of product line profitability is difficult to justify in the context of what neobanks are bringing to the table. And clearly, it's finding a very willing audience in the form of consumers.
And I think, for historical analogies, if you look outside of FinServe, I go back to when online services first cropped up, sort of even pre-AOL, Prodigy, CompuServe. They were charging for things like stock quotes. And I think the analogy is that when there's a compelling value proposition that someone's willing to pay for, that there's going to be a company that emerges that will find that it's going to be in their best interests to give it away for free. Mm-hmm. I think that's coming true with neobanks.
That's a great point. So I guess, one more recent phenomenon that we're also seeing that's worth highlighting is this example of identity neobanks that we're seeing crop up. And you can see 6 different examples of what we're terming identity neobanks happening. And this really comes down to the barriers for entry dropping. And now you're seeing neobanks emerge for smaller customer segments. So targeting a smaller total addressable market, but going for higher penetration. And you can see examples of neobanks that target people with disabilities, particular races and ethnicities, musicians, even LGBTQ. So all of this represents, if you are a legacy bank, maybe each one of these on their own might be a tenable loss, but collectively, it could pose the risk of death by 1,000 cuts. So it's a pretty profound, phenomenon that we're seeing play out that is definitely worth keeping your eye on.
Ted, I know we talked about this. Ted asked in advance, what's the barrier of entry for startups?
Yeah, well, I can put some numbers on that. So Cheese, First Boulevard, and Daylight each have 5 million or below in total seed funding. And we expect that the barriers will come down even further still. as banking as a service has sort of a similar effect as Amazon Web Service did on startups, where suddenly it becomes so easy to bring something to market. So each of those providers that we highlighted on the previous slide will fall into the other category in red in this projection of market share over time among neobank providers. And you might think, looking at this with that other category representing around 10% of the total market, and that holding still over time, that they're stagnating. But the reality is they're keeping pace with market growth as a whole. So other providers had about 2.5 million account holders in 2021, and that will roughly double by 2025 to 5 million account holders. And because of the smaller valuations among this group, there could be potentially attractive acquisition targets here for banks. And we're going to touch more on that later. But that still leaves 90% of the market held among the top 4 neobanks. And at this point in the presentation, we're going to dive into each. We're going to talk a little bit about their growth, their strengths, and some of their risks. So number 1 is Chime. It's the biggest neobank. It has 13 million users and a $25 billion valuation. And that scale means network effects. It means brand recognition. It gives them word of mouth growth. It gives them the resources to match any distinctive features that its competitors bring into the market. And we currently have validated through our research, they have the most distinctive and in-demand mobile emerging features according to our own benchmarking research. And the fact that they are a front runner also poses a risk because it could attract unwanted attention from regulators, from media, and all that is beginning to play out. So Chime needs to ensure that its blitzscaling doesn't involve cutting corners. That's its biggest risk, is reputational damage. Number 2 is Currents, number 2 in terms of size, but definitely number 1 in terms of its growth rate. So the neobank is going to hit 4 million users as of 2021. And in 2020, its users, as you can see, skyrocketed 360% year over year, which is more than 5 times the growth rate of runner-up Varo. So how did it do this? Its secret sauce is really marketing. It's not its product set per se. It features testimonies from teams and creators, both user-generated and paid, and it also engages an army of influencers to promote it. So as others follow suit, which we expect will happen, Current's biggest risk is losing its marketing edge. And you can see some of the edgy slogans that it brings to the table here. We're not a bank. There we said it. Hold that in your head as we contrast it to the next neobank, which you're about to see on the screen. Varo is the only one of the neobanks that can make the claim they are a bank for all of us. They are the only one who can claim to actually be a bank. And its strength and its weakness are really one and the same and tie into the fact that it can call itself a bank. It's its charter. And the process of obtaining that charter was definitely not easy. So it reportedly spent over 100 million or nearly $100 million over the course of 3 years, navigating regulatory and capital requirements. And for its efforts, it can offer a full spectrum of banking services. It's not beholden to a licensed partner. And it isn't beholden to some banking regulations that can vary a lot state to state, which offers it the ability to roll out more uniform products. But again, its biggest risk is that its charter introduces a very heavy compliance burden that incumbent banks know very well.
Theta asks, it's a good spot. What's the relationship between neobanks and banking as a service?
So many neobanks are consumers of banking as a service providers. Varo would really be the only one who could offer up a full stack banking as a service offering into the market because it is the only one that actually has its own license. We're seeing an example from Starling overseas of starting to roll out banking as a service as another revenue stream. So Varo could potentially choose to pursue that eventually. But for the moment, it's important to think of neobanks as consumers of banking as a service providers. Final in our gang of 4 is Aspiration. So Aspiration, and this is a very important point, is going to ride the wave of demand for sustainable brands. So that might feel like a marketing gimmick, but it's actually something that's very core to its identity. And you can see here that the percentage of Americans alarmed about climate change has risen from 11% in 2015 up to 26% as of 2020, We expect that to raise further still, right alongside the average weather. And honestly, I'm surprised that the numbers aren't higher already. And Aspiration has attracted a lot of interest, but from both consumers and also star investors. So Leonardo DiCaprio, as an example, what it's trying to do is upsell to an increased average revenue per user. And one of its biggest risks is that other banks are catching on to consumer demand for sustainability, and they're starting to go green too. And all that could sort of undercut its value proposition.
We have another question about, which fits here, is how satisfied are neobank customers?
So we have data on all of them overall, but I'm just going to highlight Aspiration because it's relevant and interesting. Looking at its investor deck, it claims an NPS score that is actually right on par with Apple and Amazon. And many of the other neobanks have exceptionally high NPS scores and retention rates over time. And all of that means that they're able to take a long view of customer profitability and think about the full suite of services they're going to cross-sell them on. And they can justify rolling out much more attractive services to lure them in from the outset. So on that point on upselling services, this is another one that was pulled from Aspiration's deck, which was an incredibly interesting read, actually. You can see the average revenue per user for Aspiration and how it increases with cross-sell here. So starting at 120, that's the baseline free accounts where customers choose what they want to pay in terms of fees. That rises by $60 if you introduce a premium account, another 60 for an investment account. The big leap happens when you introduce a credit card, and that is going to be the next battlegrounds for a lot of these neobanks, starting with kind of the secured credit cards, but growing in time to include cashback and T&E.
Yeah, because Jamie, that's a question that Jamie had, which is how is digital banking competing with traditional cards?
Yeah, I mean, it's a great point. The first battleground is going to remain secured cards.
For young kids, yeah.
Yeah, and also reporting things like paying rents to build up credit and increase their base of customers that they can sell these services because they might not have access to a credit history. And we expect that there's no shortage of places that they could go from sort of that beachhead too. So we've listed out some other financial services that might be on the table to the right here. And we expect a lot of competition across everything here and more over time.
That's Gustavo asked how he wants to know if it's possible to become a full service bank without branches. And I can take this. So if you look on the different services like small business banking, corporate banking, asset management, it is possible to do it without branches. The only reason that a business would require a branch is if, for example, it's a retailer that needs a location for cash drop for cash. But when you look at the other services that a bank can offer a business, it doesn't necessarily need to be directly in a branch. Traditionally, relationship managers with local businesses sat in branches, but they don't have to. So I think that it is possible that a bank can become a full service bank without branches. And we're already starting to see some of the services that banks are offering are moving more towards businesses.
That's, I couldn't have said it better myself. And just to underscore that point, I think if there was a question of whether it was possible after the pandemic, that certainly puts that to bed because it was necessary to run those customer relationships without the benefit of a branch for a prolonged period of time. And all of this, the consumer markets, the credit card market, and all the other services that can be cross-sold is such an attractive total addressable market that we know it's not going to just be the incumbent providers versus the neobanks. The market will include folks like big tech, PayPal, and many others like commerce platforms competing for these consumers. And the market has never really been as competitive as it is today, but also will only heat up from here. And what you're looking at is leading providers that US consumers or US digital banking users would trust most to provide banking services. Primary bank, still in the lead, but it's their advantage to lose as many other providers are hot in their heels.
So that's our view on the market over the next 5 years, according to the information we have today. But what could turn the market on its axis?
That's a great question. In the full report, we go through 5 different examples. For the purpose of this presentation, we're just going to bring it down to 3. And so these are the 3 top disruptors that could shape up the market. So we built our forecasts with all the available information we have, but if there were some changes according to these 3, that could shift some of our estimates. The first is the OCC handing out special purpose fintech bank charters, something they've been talking about for years.
So, Spencer asked just on this point, will neobanks be able to obtain banking charters and untether themselves from other depository institutions to ensure their assets and credit? And if so, how should large banks prepare strategically for the landscape shift?
It's a great question. It's too early to say how exactly this is going to turn out. So I mentioned the fact that the special purpose bank charter would be a disruptor. It would be a disruptor because it represents another potentially more attractive means for providers to obtain a banking license. And we noted the fact that Varo is really the only one of the top neobanks who has done that work. Recently, the news on this front occurred in June when the DFS, who has challenged the OCC's charter in court, had their challenge thrown out by the appeals court. However, there is still the possibility for the DFS to bring action again in the future. So we don't have a crystal ball. It's unclear what is going to happen with these challenges in the court. But what is clear is that it's necessary to plan for either scenario. Either this does or this doesn't happen. As the saying goes, plans themselves are useless, but planning is essential. And I will also say that many neobanks, even if this does come to fruition, might decide that the higher interchange they can capture if they spread their deposits across multiple institutions, each of which is below the $10 billion cap, according to Durbin, they might choose to pursue that, just in order to capture more revenue. Sure. So second disruptor, and heading right along, is regulators cracking down on neobanks. Somebody asked how neobanks are regulated, and here are numerous examples of how there's more favorable treatment for non-banks, including neobanks, as compared to banks. These were pulled from Jamie Dimon's Investor Day presentation. If they don't have a license, they can't call themselves a bank, but non-banks, neobanks, other fintechs do enjoy fewer data restrictions, higher debit income, lower KYC requirements, and so many more. So if these advantages were to roll back, that could mean the barriers from entry from a regulatory perspective become a lot higher, and the market gets potentially a little bit less crowded. Third disruptor, and then we're going to go into what to do about this threat. The third disruptor is investors losing patience with unprofitable neobanks. So Chime claims to be profitable, which makes them very much an outlier. Starling has had months of profitability and says that they are on track for a full year in the black in 2022. Not many others are even making this claim. And whether that's adjusted EBITDA, whether that's marketing, accounting magic like EBITDAM. And so in an economic downturn, you might see a lot of investors pulling back from this market, and that could also force a contraction. So final few slides, what do banks do? We list out a larger maturity model in the full report that this webinar is based off of, and we break it down into 3 stages of response, from more accessible steps to more extreme. And here are 9 possible moves that banks might consider pulled directly from that model. The first is centering your value proposition on distinctive money management features can help you stand out. And we know from doing benchmarks in the US and the UK of neobanks versus upstart providers, as well as Canadian benchmarks on their emerging features, that many traditional banks actually have better money management features than neobanks. And Citi, for instance, leads in the money management category of our US benchmark, they should be touting that fact to attract this same group of customers. Second recommendation is to incentivize direct deposit setup from account opening. So Chase, for instance, is offering $225. Varo is offering $200. Many of the lures that neobanks hold out there to attract customers, like early direct deposit access, are predicated on setting up direct deposit or early paycheck access, rather. So third recommendation on this slide is to promote digital options to speak to real people. This is something that many neobanks struggle with, and our studies show that people love features that allow them to connect with real people, not so much chatbots yet today. US Bank, for example, takes it a step further with video co-browsing options. Moving on to stage 2. So this is bringing providers into closer competition with neobanks. Consider biting the bullet on core cloud migration. Easy to say and very hard to do. Chase, for instance, is migrating to Thought Machine, a cloud native provider, something that will be very expensive and very time consuming, but for its efforts, will have so much more agility as a result. Second is to optimize digital account opening, getting the time down as low as possible. Apple Card claims that they can get signups in as little as 1 minute. 10 times that we think is a pretty good benchmark for providers to aim for. And third is to promote neobank-like features. So Huntington proudly touts the fact that you can get paid 2 days early, as it rightfully should, because there's a lot of consumer demand for that feature, and it's definitely distinctive. Stage 3 contains the boldest moves, and the first of those is acquisitions. So Fifth Third bought niche neobank healthcare provider Provide, for example. And there are many other examples among the identity neobanks that might be ripe acquisition targets for providers. Second is to outgun neobanks. So supporting cryptocurrency custody is not something that many neobanks offer. FIS is planning to enable this soon via a partnership. Third is to market distinctive neobank or features that neobanks don't yet have. So Chase, for instance, supports the ability to stop checks, ACH, other sort of transfers. Our new US neobank benchmarking study will allow providers to see a lot of different gaps that neobanks have in their feature sets. And when you're filling one of those gaps, you should be touting that fact in order to stand out. So that's the end of our maturity model, but I would be remiss if I didn't call out another threat that we're very closely focused on in our research, which is the rise of financial services everything stores called super apps. If you're not already thinking about this threat and how you fit into the equation, definitely recommend doing so. We'll soon release a matrix stacking up the top global super apps, including some recommendations. So that brings us to the end of our formal presentation and on to the Q&A.
That was great, Dan. Thanks for going through all that data. Now it's time to take more questions, and we did receive a bunch in advance. Thank you. We've gone through some, but we still have more to go through. So I'd like to, while we have time, we're doing okay. I'd like to spend a few minutes talking about the questions that we received in advance. And then we have a handful of questions, if we can get to them, that came as we were talking. So the first question from Saswata is, which aspect of the banking function is the most difficult to replicate by a neobank? I feel like I can answer that. That would be branches.
I would tend to agree. And I looking down the list of questions, I also see a question from April, which is, what are advantages of traditional banks versus neobanks? So we saw earlier, branches, I would say is a big one. Yeah. The ability to talk to live people love that. The ability to have all the services that a traditional bank would have. And then the long tail of customer needs. So moving from one rental unit to the next, you might need a cashier's check. And many neobanks might not choose to offer some of those things. So thinking of the long tail of customer needs, thinking physical, those are all advantages that providers have. And then trust is also a an intangible that is tilted in neobanks or legacy banks' favor at the moment. So we saw that primary banks remain the #1 trusted source for the moment. But if you don't cultivate that trust, that advantage won't remain forever.
Then, great, thank you. Lewis asked, where do digital banks hold their deposits?
So there are a whole network of providers like the Bancorp Bank that specialize in this. And like I said before, if you spread your deposits across multiple of these providers, then you can enjoy more favorable interchange rates. So that's an advantage that a lot of these neobanks are looking into.
Great. Daniel asks, what triggers have proven most effective in generating new account creation in the consumer space?
So the way that we like to look at this is the feature set and break it down by customer demand. So if you look at how a neobank goes through value prop messaging, they bring it down to a few distinctive features that have incredibly strong demand among consumers. And what we like to do is survey prospective customers on their demand for each of those features and then rank order it. So typically every year we'll identify about 49 of them, rank order them by consumer demand, see who offers those features among neobanks and incumbents. And then if you're looking at the top list of most in-demand features, like for instance, one of the most in-demand features for cashback credit cards is the ability to detect if your social security number was compromised in a data breach. And that is an example of a feature that you should be touting in order to bring customers in. And also to reiterate a point from before, it's not just enough to capture a customer relationship. You're aiming for direct deposit from the account opening stage. So services that require direct deposit setup to be made possible, like the ability to get early paycheck access, those also tie into getting primacy from day one.
Great. Emil asks, how can incumbent banks leverage the ambition of neobanks to create partnerships? And in what ways, if at all, could these partnerships create new value for consumers?
It's an interesting question. I think a lot of these neobanks are pursuing a direct-to-consumer type of approach at the moment. It was also interesting to see Google sort of ignominiously pulling back from the banking space with Google Plex and the surprise unraveling as banking as a service relationships. It was speculated, presented sort of a conflict of interest with providers. I think a lot of the neobank to legacy bank interactions that we'll see will come in the form of acquisitions, specifically within the identity neobank space. So we predict a couple of those acquisitions to take place looking ahead to 2022. In terms of other partnerships, we're seeing partners or providers like Revolut overseas digging into the sort of everything store super app model, where providers might be plugged into the back end, into a marketplace. I expect a lot of direct to consumer type of approaches playing out among neobanks. So in terms of partnerships, looking ahead into 2022, limited activity probably from my perspective.
Great. Mercedes asks, do you see online-only bank accounts being a good product for underserved communities, specifically unbanked people who had a bank account at some point but decided to end that relationship?
Yeah, I would say definitely. A lot of these providers offer services that help build credit. So we talked about an example like, I forget the specific provider, but one of them was reporting rent payments or other payments that are not traditionally reported to build up credit. We're also seeing examples like early paycheck access or the ability to go into overdraft without getting hit with a punitive fee. All of those features are specifically designed to be resonant with this underbanked or unbanked population. In the US, we have over 6% of US households, 14 million American adults who are unbanked. We expect that more of these neobanks will be competing for those customers, but they'll also come up against providers like Square with Cash App, PayPal with Venmo, that are non-traditional servicing providers that have made inroads with the same group.
I would argue that the check cashing stores could also become virtual competition as well. And, I know that they get a very bad reputation, deservedly so in many cases, for the fees that they charge. But I recently read research from, I don't remember the source, sorry about that, but I recently read research about unbanked and people who use those check cashing stores. And while they do charge high fees, they are very transparent about what they are charging and what you're receiving. And that's what those people actually like compared to a bank, is no hidden fees. You can't overdraw. You're not going to get hit with fees that you're not familiar with or aware of. And that's why they like them. So I wonder if we'll see services grow from that for unbanked.
That's a great point. And maybe it does require like a physical network to get cash in and cash out to really make inroads with that particular market group. And if that were the case, I expect that to play out through partnerships with, say, 7-Eleven or other retailers who might benefit from more foot traffic and could form partnerships with neobanks.
I think we have just a few minutes, so I'd like to just hit 2 more questions if we can. Thank you, everybody, for all your questions. It's been really great. Jenna asks, what insights can you share about the revenue mix for neobanks?
Insights on the revenue mix for neobanks. Well, Aspiration is one of those that actually break down the revenue mix and project it out over time. So you can see the balance of, interchange or the margin spread for some of those accounts, making up actually a surprisingly small amount of the overall revenue mix. They capture a lot of revenue from ESG services. So many of the funds that they bring into market have a low baseline rate, but customers can choose to pay more. They've also struck in partnerships with merchants who they deem sustainable, and they get kickbacks as a result of those partnerships. And so they're very diversified in terms of their revenue stream. Does it add up to profitability? No, and no time in the future will it make that switch. But they're clearly taking a long-term view of their own growth trajectory.
Great. Thank you. Let's finish with Octavio asks, are neobanks able to balance blitz scaling with costs associated with customer service?
I guess it comes down to how you define balance. If you define it as getting in the black, no, no, they're not. But if you break down getting in the black differently, then maybe yes. So I very briefly referenced this term EBITDAM, which is a form of accounting where you exclude marketing to calculate profitability. And that's something that Aspiration, some of the other neobanks have chosen to use. And that's how they calculate profitability. It sort of brings to mind for me comparisons with WeWork's community adjusted EBITDA. it's clearly favorable in their own terms. But if you take a long-term view of the customer relationship and say, we're going to take the hit when it comes to onboarding, but we're going to balance over the long term things like customer servicing costs, we're keeping those down low. We saw a $50 average cost estimate from Oliver Wyman over time, and factor into that cross-sell, then maybe you're setting up for a growth in customer lifetime value over time that makes up for the loss that you take early.
That's great. Unfortunately, that's all the time we have for. Dan, thank you so much for sharing your insights with us today. Our production crew behind the scenes also deserves a huge thank you for making this webinar possible. We hope that all our attendees found the presentation useful and valuable, and that you learned something that's going to help you and your business. Please remember to keep an eye out on your email for a link to today's presentation so that you can reference back to the data and insights that we shared today. Again, I want to thank you for joining us, and please enjoy the rest of your workday.